I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Efficiently Inefficient by Lasse Heje Pedersen is a book that explores the world of finance and investment through the lens of behavioral finance. The author provides a thorough analysis of various investment strategies that are used by professionals in the industry, highlighting the strengths and weaknesses of each approach. Pedersen argues that traditional finance theory assumes that investors are rational and have access to all the information they need to make informed decisions. However, this is not always the case. In reality, investors are often irrational and subject to cognitive biases that can lead to poor investment decisions. The book delves into the concept of alpha, which refers to the ability to generate returns that are higher than what would be expected based on market conditions. The author provides examples of how alpha can be generated through various strategies, including arbitrage, momentum trading, and fundamental analysis. Pedersen also examines the role of hedge funds in the financial industry and how they are able to generate alpha through their unique investment strategies. He argues that despite their controversial reputation, hedge funds play a valuable role in the financial ecosystem by providing liquidity and serving as a counterbalance to traditional asset managers. Throughout the book, Pedersen emphasizes the importance of understanding both the efficient and inefficient aspects of the market in order to make informed investment decisions. He stresses the need to adopt a flexible approach to investing, taking advantage of inefficiencies in the market when they arise. Overall, Efficiently Inefficient is an engaging and informative book that provides a unique perspective on the world of finance and investment. The author's insights and analysis will be of interest to both seasoned professionals and novice investors looking to improve their investment strategies. Point 1 of Efficiently Inefficient by Lasse Heje Pedersen explains that traditional finance theory assumes that investors are rational and have access to all the information they need to make informed decisions. However, in reality, this is not always the case. Investors are often subject to cognitive biases that can cloud their judgment and lead to suboptimal investment decisions. These biases may include overconfidence, herd mentality, and anchoring bias, among others. Furthermore, investors may not always have access to all of the information they need to make informed decisions. There may be asymmetry of information between investors, where some have more or better information than others. Additionally, some information may be difficult to obtain or may be intentionally concealed by companies or other market participants. Behavioral finance recognizes these limitations and attempts to incorporate them into investment theory. By understanding the ways in which investors may be irrational or limited in their decision-making, behavioral finance seeks to provide a more accurate and realistic model of the market. Overall, Point 1 emphasizes the need to consider the limitations of traditional finance theory and to incorporate insights from behavioral finance in order to make more informed investment decisions. Point 2 of Efficiently Inefficient by Lasse Heje Pedersen explains that investors are often subject to cognitive biases that can lead to poor investment decisions. These biases are inherent in human psychology and can manifest in various ways, including overconfidence, confirmation bias, and loss aversion. Overconfidence can cause investors to overestimate their own abilities and the accuracy of their predictions. This can lead to taking on excessive risk or holding onto losing positions for too long. Confirmation bias occurs when investors seek out information that confirms their pre-existing beliefs while ignoring information that contradicts those beliefs. This can lead to a narrow focus and an incomplete understanding of the market. Loss aversion refers to the tendency for investors to feel the pain of losses more acutely than the pleasure of gains. This can lead to a reluctance to take on risk or to cut losses early, resulting in missed opportunities or increased losses. These biases can be difficult to overcome, but recognizing them is the first step in mitigating their effects. By acknowledging the limitations of their own decision-making processes, investors can make more objective and rational decisions. Overall, Point 2 highlights the importance of understanding the role of cognitive biases in investment decision-making and the need to actively work to counteract their effects. By recognizing these biases and implementing strategies to mitigate their effects, investors can improve their overall performance. Point 3 of Efficiently Inefficient by Lasse Heje Pedersen refers to the concept of alpha, which is a measure of an investment's excess returns relative to a benchmark. In other words, alpha is the ability to generate returns that are higher than what would be expected based on market conditions. Alpha can be generated through various investment strategies, including arbitrage, momentum trading, and fundamental analysis. Arbitrage refers to the practice of exploiting price discrepancies in different markets, such as buying an asset at a lower price in one market and selling it for a higher price in another. Momentum trading involves buying assets that have shown positive performance in the recent past, with the expectation that the trend will continue in the future. Fundamental analysis involves analyzing a company's financial statements and other data to determine its underlying value and potential for future growth. Generating alpha is the goal of many investors, but it is not always easy to achieve. Alpha can be influenced by various factors, including market conditions, investor sentiment, and the effectiveness of an investment strategy. Additionally, as more investors seek to generate alpha using similar strategies, the potential for returns may be diminished. Overall, Point 3 emphasizes the importance of understanding the concept of alpha and the various strategies that can be used to generate it. However, investors should also be aware of the risks and limitations associated with these strategies and should adopt a diversified approach to investing to manage these risks. Point 4 of Efficiently Inefficient by Lasse Heje Pedersen explains the various strategies that can be used to generate alpha, including arbitrage, momentum trading, and fundamental analysis. Arbitrage involves taking advantage of price discrepancies in different markets to generate profits. For example, if a security is trading at a lower price in one market than in another, an investor can buy the security in the lower-priced market and sell it in the higher-priced market to make a profit. Momentum trading involves buying assets that have shown positive performance in the recent past, with the expectation that the trend will continue in the future. This strategy is based on the idea that markets are not always efficient, and that there may be trends or patterns that can be exploited for profit. Fundamental analysis involves analyzing a company's financial statements, industry trends, and other data to determine its underlying value and potential for future growth. This approach seeks to identify companies that are undervalued by the market and have the potential to generate significant returns over the long term. Each of these strategies has its own strengths and weaknesses, and may be more or less effective in different market conditions. For example, arbitrage opportunities may be more prevalent in volatile markets, while momentum trading may be more effective in trending markets. Overall, Point 4 highlights the importance of understanding the various strategies that can be used to generate alpha and the conditions under which they are most effective. Investors should consider their own risk tolerance, investment goals, and market conditions when choosing an investment strategy. Point 5 of Efficiently Inefficient by Lasse Heje Pedersen discusses the role of hedge funds in the financial industry and how they are able to generate alpha through their unique investment strategies. Hedge funds are investment funds that are typically open only to accredited investors and have the ability to use a wider range of investment strategies than traditional mutual funds. These strategies may include long-short equity, event-driven, and global macro strategies, among others. Hedge funds are often able to generate alpha by exploiting market inefficiencies and taking advantage of unique investment opportunities. For example, a hedge fund may use a long-short equity strategy to take long positions in undervalued companies and short positions in overvalued companies, generating profits from the difference in price. Despite their controversial reputation, hedge funds play a valuable role in the financial ecosystem by providing liquidity and serving as a counterbalance to traditional asset managers. Hedge funds may be more willing to take on risk and make contrarian bets than traditional managers, which can provide opportunities for investors seeking higher returns. However, hedge funds are not without their risks. Their use of leverage and complex investment strategies can result in significant losses in volatile market conditions. Additionally, their high fees and lack of transparency may make them unsuitable for some investors. Overall, Point 5 highlights the unique role that hedge funds play in the financial industry and the potential benefits and risks associated with their use. Investors should carefully consider their investment goals, risk tolerance, and other factors when deciding whether to invest in hedge funds. Point 6 of Efficiently Inefficient by Lasse Heje Pedersen discusses the value that hedge funds provide to the financial industry by serving as a counterbalance to traditional asset managers. Traditional asset managers, such as mutual funds and pension funds, typically have a long-only investment strategy, meaning that they only buy stocks with the expectation that their value will appreciate over time. In contrast, hedge funds have the ability to use a wider range of investment strategies, including short selling, which involves selling stocks with the expectation that their value will decline. This ability to use short selling and other strategies can provide a counterbalance to traditional asset managers and help to improve market efficiency. For example, if a hedge fund identifies a company that is overvalued and sells its stock short, this can put downward pressure on the stock price, bringing it more in line with its true value. Additionally, hedge funds can provide liquidity to the market by buying and selling securities, helping to ensure that there are always buyers and sellers available for a given asset. However, hedge funds are not without their limitations. Their use of leverage and complex investment strategies can result in significant losses in volatile market conditions, and their high fees and lack of transparency may make them unsuitable for some investors. Overall, Point 6 highlights the importance of hedge funds in providing a counterbalance to traditional asset managers and improving market efficiency. However, investors should carefully consider the potential risks and limitations associated with hedge funds before making investment decisions. Point 7 of Efficiently Inefficient by Lasse Heje Pedersen emphasizes the importance of understanding both the efficient and inefficient aspects of the market in order to make informed investment decisions. Efficient market theory suggests that markets are rational and that prices reflect all available information. However, in reality, markets are not always efficient, and there may be inefficiencies that can be exploited for profit. For example, fundamental analysis can help investors identify companies that are undervalued by the market, while momentum trading can take advantage of trends and patterns in market behavior. Similarly, arbitrage opportunities may arise when the same security is priced differently in different markets. By understanding the inefficiencies in the market, investors can develop investment strategies that take advantage of these opportunities for profit. However, it is also important to recognize that markets can be efficient in some areas, such as large-cap stocks, and that attempting to exploit inefficiencies in these areas may be fruitless. Furthermore, investors should also be aware of the limitations of their own decision-making processes and the role of cognitive biases in investment decisions. By recognizing these biases and actively working to counteract their effects, investors can make more objective and rational decisions. Overall, Point 7 highlights the importance of understanding both the efficient and inefficient aspects of the market and developing investment strategies that take advantage of these inefficiencies while also managing risk and recognizing the limitations of human decision-making. Point 8 of Efficiently Inefficient by Lasse Heje Pedersen emphasizes the importance of adopting a flexible approach to investing that takes advantage of inefficiencies in the market when they arise. Investment opportunities can be dynamic and may change quickly in response to market conditions or other factors. As such, it is important for investors to be flexible and adaptable in their approach to investing in order to take advantage of these opportunities. One way to be flexible is to diversify one's portfolio across different asset classes and investment strategies. This can help to spread risk and reduce the impact of any one investment on overall portfolio performance. Additionally, diversification can provide exposure to different areas of the market and help to capture a broader range of investment opportunities. Another way to be flexible is to maintain a long-term perspective and avoid making impulsive decisions based on short-term market fluctuations. By staying focused on long-term investment goals and maintaining a disciplined investment approach, investors can avoid the pitfalls of emotional decision-making and improve overall portfolio performance. Overall, Point 8 highlights the importance of adopting a flexible and adaptable approach to investing that takes advantage of opportunities as they arise while also managing risk and maintaining a long-term perspective. By diversifying one's portfolio and maintaining a disciplined investment approach, investors can improve their chances of achieving their investment goals. Point 9 of Efficiently Inefficient by Lasse Heje Pedersen emphasizes that successful investing requires a combination of skill, luck, and diversification. Investing involves a certain degree of risk, and no investment strategy can guarantee success. As such, investors should be aware of the role of luck in investment outcomes and the importance of diversification in managing risk. While skill and expertise can certainly improve investment performance, luck can play a significant role in investment outcomes. For example, a well-timed investment in a high-growth company may result in outsized returns, even if the investment was based on luck rather than skill. Diversification is also important in managing risk and avoiding concentrated exposures to any one investment or sector. By diversifying across different asset classes, investment strategies, and geographic regions, investors can reduce the impact of any one investment on overall portfolio performance and improve the chances of achieving their investment goals. Overall, Point 9 highlights the importance of recognizing the role of both skill and luck in investment outcomes and adopting a diversified approach to investing in order to manage risk and improve overall performance. By combining skill and expertise with a disciplined and diversified investment approach, investors can improve their chances of achieving long-term investment success. Point 10 of Efficiently Inefficient by Lasse Heje Pedersen emphasizes the importance of staying up to date on new trends and developments in the financial industry in order to be a successful investor. The financial industry is constantly evolving, with new investment products, technologies, and regulations being introduced on a regular basis. As such, it is important for investors to stay informed and up to date in order to make informed investment decisions. For example, advancements in technology have made it easier than ever for individual investors to access global markets and invest in a wider range of asset classes. Similarly, changes in regulations and tax laws can have a significant impact on investment strategies and portfolio performance. Staying up to date on new trends and developments can also provide insights into emerging investment opportunities and areas of growth. For example, the rise of renewable energy and the increasing importance of environmental, social, and governance (ESG) factors in investing may present new opportunities for investors looking to align their investments with their values. Overall, Point 10 highlights the importance of staying informed and up to date on new trends and developments in the financial industry in order to make informed investment decisions and identify new opportunities for growth and success. By staying informed and maintaining a disciplined investment approach, investors can improve their chances of achieving their long-term investment goals. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.